Those low oil prices prompting ConocoPhillips to cut spending on projects next year by 25%. It also follows similar moves by other big oil companies. The response in the stock price was positive, with shares rising about 1.5%. Morgan Brennan has more on the latest energy company to feel the heat from the slide in crude.
The U.S. oil major releasing its operating plan and capital budget for 2016 today, and the latest round of cuts are steep. ConocoPhillips' 2016 capital expenditures, or CapEx, will be $7.7 billion, down 25% from its expected budget of $10.2 billion this year, and a hefty 55% lower than in 2014. It's the latest reduction from a company that lowered its 2015 budget 3 times this year. The other big focus of Conoco's plan, the dividend, which currently yields 6%. A number of energy companies have slashed payouts, including Kinder Morgan and Freeport-McMoRan. But Conoco executives insist that maintaining the stock's dividend is a, quote, top priority. That's a factor that has kept investors interested in the largest energy companies, despite ongoing commodity weakness.
The big issue is that we're all living in this very low return environment. So we've got negative real rates on the short end, 0 real rates at the 10-year bond approximately. So everything's been shifted down. So people that are really looking for 7% plus returns over the next 3 to 5 years have to be more creative. And one of the ways is to go to where the pain is.
Conoco also plans to cut operating costs further in 2016, but production is still expected to grow 1 to 3% as several major projects come online. The company will also continue to sell assets. And all of this follows on the heels of another oil and gas giant, Chevron, announcing that it too will slash its spending 24% next year. For Nightly Business Report, I'm Morgan Brennan.